Welcome to the Tower Wealth Advisory podcast series. I'm Tyler.
I'm Dave.
And today we're chatting about long-term care insurance. Do we need it? How does it work? What's the point of it? So why don't we just jump right into it?
Sounds good.
So I got a few slides here. Long-term care insurance coverage. What is it? So I've got a bit of a breakdown here. Long-term care insurance is actually a living care benefit. So what does living care mean or living benefits mean? Everybody's heard of life insurance. I mean, that's pretty common, but living benefits are things that pay to you while you're alive. So when you're on claim, you're living and you're receiving those benefits to help with your costs, your budget, trying to keep track of everything and expenses that may occur if you're not healthy. So long-term care is a living benefit that pays for your long-term care needs. Now, how do you qualify for it? It's mostly based upon your activities of daily living. We've got them listed here on the bottom of the slide, but if you can't see them on this podcast, they are bathing, eating, dressing, toileting, transferring, and maintaining continence. There is one other one that is a cognitive impairment, so things like Alzheimer's disease. That would, of course, affect all of these activities of daily living, so you're immediately on claim if you have a cognitive impairment. So if any two of those daily living activities are something that you are unable to perform, you're considered to be on claim and you're receiving the benefit from your long-term care insurance policy. So why do people get long-term care insurance? It helps you pay for long-term care services, which means you won't have to rely on your family or for financial help for hands-on care, or both. It gives you and those you care about the opportunity to spend quality time together. So, Dave and I, we joke about this from time to time, but when you think about, what goes into caring for a person in long-term care, things like, toileting, dressing, do you want your kids or your spouse having to perform those activities for you, help you perform those activities? That's the purpose of this insurance, is to provide you some kind of cash injection so you can hire that service out.
Well, for sure. I think one of the big things here is most people, when they think of long-term care, they just think of government-run facilities and they get on a list and then their name comes up and they go in and they get to pick the place they want to go to, and all of those things are very difficult to achieve. Going through that scenario here with a family member and you're on a list and you get to pick maybe your top 2 or 3 places you want to go, but you could be separated by a pretty big distance from your spouse. If you're married, for example, you might be going into a long-term facility that isn't the one around the corner. It could be 20, 30 kilometers away. And how do you get there to visit your spouse? I mean, usually when these scenarios are happening, people are a bit more elderly, but not always. But for the most part, that's the case. So the whole point of this insurance is to have something to maybe give you more options. Can you pick a spot that you want? So even government-run long-term care facilities have a certain set of the beds in each of their facilities that are private. And by private, it means you get to pick the one you want to go to. If you were there because the government chose that place for you, you're paying the government rate. But if you choose that that's the one you want to go to, there's a higher rate. Same place, you're not getting anything special, just you get to pick the one you want to go to. So that costs more money. Maybe some of these, the daily living is somewhat manageable, but like you said, you might want to have someone come into your house. So you don't want to go to a facility. The longer you're in your own house, most people prefer that. But those things cost money and or your spouse or your family starts to do it. And so I think what we found is when people have insurance or versus having the money. There's a lot of people who have enough money to afford these things, but it's different. When they have that money and they're at home, a lot of times they still don't want to pay to have someone come in. They'd rather have family members do it. But when they have insurance, they're fast to use insurance. And then they would hire someone in. So I don't know if it's a mindset that happens to people.
Yeah, I agree. I was thinking about it before we were having this conversation. And it seems as if here in Alberta and in Canada in general, we have this belief that we're to be looked after in the healthcare facilities. So to pay for something out of pocket for healthcare seems, strange to our communities, to our society. So you're right. When people have insurance, they're quick to claim on it. I mean, they've paid the premiums for it. They're quick to when they see the opportunity to claim, they jump at it. Mm-hmm. So, yeah, good points.
But if they save the money up instead of buying the insurance, they're not quick to spend their money.
Yeah,
because they don't want to run out of money.
Yeah, they'll lean on their spouse for that care. They'll lean on their family for that care.
Which I think is detrimental in a lot of ways.
Relationships for sure. So we go to the next slide. We've started to touch on this, but what are long-term care services costs looking like? like, so why does this insurance exist? Well, it exists because it's very expensive to get this care. I just looked up these details yesterday. This is from a company down in Calgary. In Alberta, their cost for in-home companion service is $30 an hour. Now, companion service isn't really any kind of nursing care. That's really somebody just to come in, spend time with you, help you cook a meal, that sort of stuff. It's not very hands-on.
I was going to say they might get up and get you a glass of water. But
yeah, exactly. They're not doing a lot for you.
Right.
At $60 an hour, that's where you're looking at in-home nursing service care. So this adds up very quickly. I mean, if you just look at 4 hours a day at $30 an hour, so just that companion service care, your monthly cost right there is $3,400 monthly.
And even at 4 hours, I mean, when you look at that list again of the 6 things that
the activities of daily living.
Activities of daily living. And if you can't do 2 of them, I mean, you're talking getting in and out of bed. Well, you got to get in and out of bed, well, minimum twice a day. Yeah. Well, those aren't 4 hours apart.
That's right.
So it's hard to hire someone to come for 1 hour and then come back for another hour. You're not going to have the same person. So you can see at $3,400 for 4 hours might help you in the morning or the evening, but probably not both. So this cost can go astronomical. Yeah. To want to be at home and have some kind of help beyond your family is going to be costly.
It can jump fast. Yeah. So our next slide is, again, in regards to what do they cost. Now, this is switching gears a bit and talking about facility care. And you have to be eligible for facility care in Alberta. So eligibility means that you're going to qualify, as Dave mentioned earlier, for some subsidies or subsidized beds. But you can also, like you say, Dave, pay your way in if you've got the assets to do it. And that's where the long-term care insurance comes into play again. Well. Yeah. You're able to have the asset that's available to you to get the bed that you want in the facility that you want, near your family, near your spouse, whatever it might be. So, like anything, money talks and it opens doors. Way back when you were 20 trying to get into the dance club, money at the door sometimes got you in quicker. It's no different when you're getting into a long-term care facility now.
Difference is it's $100, but it's $100 doesn't go as far anymore, so it's cheaper.
Right.
I mean, when you talk about this, the long-term care services costs, we have a slide near the end that compares the provinces, but there's one province or territory in Canada where there's no cost. It's part of just being there, but you have a residency requirement to meet, just like in Alberta. Right. And then the costs in other provinces vary dramatically, and they're also tested differently. Some of them are income tested. Some of them don't, I guess they're income tested in a way, but they leave you with a certain amount of money at the end of each month. So we'll talk a bit more about how those work. And so you'll find if there's not a subsidy, and your cost is $3,000 or $4,000 per year, and you have OAS and CPP, that might make up half. But all of a sudden, you have a couple $100,000 in investment. So at $2,000 a month, you got 100 months, and it's gone, type thing.
Yeah,
so
they'll tag that on to what you can afford. Yep. Okay, we'll skip ahead to the next slide. It's fairly maybe tough to read, but basically an eligibility program is what we're talking about here. Generally speaking, and this is in Alberta, you've got to be over 65 years of age. You have to have lived in Alberta for at least 3 months immediately before applying to enter into a facility. You must be a Canadian citizen or have been admitted into Canada for permanent residence. And finally, you have an income level within the limits allowed by the program. So in general, a single senior with an annual income of 24 grand or less, and a senior couple with a combined income of 39,000 or less, they're eligible for cash benefits.
Yeah, so this is a scenario here. I mean, this example is your OAS, your CPP, and your GIS are not even enough to pay the minimum. Right. They're not going to deny you the service.
Yeah, I mean, you're not going to be left on the street.
But you will give up your OAS, your CPP, and your GIS, and the government will make up the difference.
They'll place you.
Yeah.
The next slide. The type of cash benefits. So Dave was touching on this, that long-term care and designated assisted living facilities are calculated to ensure a senior has at least $265 in disposable income every month after paying their accommodation charges. So isn't that nice of them? They leave a little bit of cash on the sidelines for you so that you can still, I guess, buy a gift for your grandkids or something like that.
Well, I think one of the provinces is $150.
Oh, yeah? That could be true. Every province, like you say, has its own rules.
Yeah.
So the amount of cash benefit a senior is eligible for is determined by 4 factors. So the type of accommodation the senior lives in, his or her marital or cohabitation status, his or her income combined with their spouse or their cohabitating partner's income, and whether the senior is eligible for federal old age security pensions. So the OAS does come into play here as well.
Yeah.
So if we go to our next slide, so obviously what we've run into here is costs can be high. Each province has a different level of support. What can clearly be seen is the support is weak at best. So these costs do need to be planned for. Just as one plans for trips in retirement, planning your healthcare in retirement should be just as important.
I think a big part of this here is if you're still married to your spouse, one of you goes into long-term care, it's two households.
Yeah, we do touch on that.
You're running two different pieces here.
That can be incredibly costly because the cost of the household doesn't change. That continues. Your taxes, your home heating requirements, your utilities bills, all that still chugs along. And now you've got to go and be in a facility or have in-home nursing care added on top of that. So the budget gets kind of blown to the wind. What we've got here, and sometimes the best way to describe how long-term care is used is basically by showing examples. I'm not going to read through the scenario, but what we've got here in scenario 1 is a low-level care requirement for a senior who is 85 years old and needs some help. So what you'll see in bullet points is the type of services that are provided in this example, and they're outlined above that in a kind of a white box above. So you'll see the monthly cost breaks out to just over $1,000. We'll call it $1,100 per month. What this person is getting is 10 meals delivered per week. That's twice a day for 5 days a week. There's $7 a meal. There's $300 that's spent there on meals. There's meal supervision for 5 hours a week, which this
half
person,
an hour meal.
Yeah, it's a half an hour meal. They struggle, with swallowing, so they don't want to choke. So they've got somebody there to basically supervise their eating. And then they've got personal care, which is bathing and dressing. That's a few times a week as well. It adds up to $186 a month. And so again, that total being $1,100. Obviously, you can see in these situations, there's going to be a case where they've got to get family members in still to help on weekends, possibly even throughout the day, because there's not somebody always there to see every meal and to help every position of personal care. So,
well, and generally, when we're looking at this, obviously this is the low-level care at $1,000. This is partly because either somebody didn't save enough money or their benefits or their pensions don't add up to enough, and therefore they can only afford the $1,000. And so that, like you said, if you look at a Cadillac plan that's expensive, whatever you take away from that is mostly going to be for the fact that you don't have enough cash flow to pay for it. Right. So whatever you take away, that service has to come from somewhere. And that's going to come from family, friends, spouses.
Yeah, and this is obviously in-home care. So, we're not in a facility here. This is the individual trying to stay in their home. Each one of these are that way. So if we jump to the next slide, and this is scenario 2, you're looking at intermediate level care. So this is more in-depth care. You're seeing the cost rise to about $1,500 per month. There's in-home meal preparation, so they're not ordering out for their meals. There's somebody in-home helping prepare meals for 2 hours a day. There's bathing and personal care 4 times a week. There's dressing 4 times a week. There's safety supervision to make sure that this gentleman can get on and off the bus in his community and back to his apartment without getting lost or falling and getting hurt. There's supervision of medication, which is 1 hour weekly. There's some laundry services being done here, and there's also some house cleaning services being done. This is not unusual stuff if you're going to be in your own home. I mean, if you need help for care, this is intermediate level. I can see how this would be very easy to require these services.
These costs are just going to go up too.
Yeah, like everything else in the world. So about $1,500 a month for this type of service. So if we jump to scenario 3, this is higher level care. So this individual needs in-home meal preparation. They need a private caregiver 8 hours daily to assist with bathing, dressing, toileting, transferring, and providing caregiver relief. Caregiver relief, of course, is probably the spouse or family that is stressed to have to deal with this individual. A private RN, registered nurse, this is 4 times a week, 30 minutes each to monitor insulin use. So again, monitoring medications. There's laundry for 2 hours every other day a week. There's house cleaning for 1.5 hours a week. And there's an occupational therapist that's involved. So this adds up pretty fast, and we see it sitting at $6,000 a month. Now, a lot of that is from, as you can see, personal care. The dressing and the bathing, the nursing kind of services that are provided there. But that's also the type of care that you're probably least likely to want to ask your family to do.
Wow. And outside of someone who earns maximum CPP and OIS, which is about $2,000 a month, you're now coming up with $4,000 a month. That's $48,000 a year. You need in the ballpark of $1 million of assets in order to generate that $4,000. That
5% return on
pretty much 5%. Yeah, 4.8.
So let's take a look at the next slide here. This is government long-term care costs. So if we look across the country at what the minimum and maximum amounts that you're going to pay, Dave, I think you entered this slide here, so you had a chance to peek at it more closely.
So
what's your comments
basically, it's just showing the minimum and maximum that you would have to pay to get into a government facility. Now, on some of them, the minimum and the max are determined based on your income. And so some will pay more for the same room as others, and some will pay less. Some are tested on whether it's just a private room or not. So like Alberta and Quebec, it's the same price. But if you wanted a semi-private private room, the price goes up for that. So and then Nunavut's if you want to live in Nunavut, you get it's all covered.
How long do you have to live there for?
I don't know about that one, but New Brunswick. You look at New Brunswick, it's $3,347 is the minimum and the maximum. Now it is income tested, and I think it's something along the lines, I can't remember 100% here, but 80% of your after-tax income. So if you make $70,000 and your after-tax is $50,000, that's $40,000. You'd be paying the maximum.
Gotcha.
80% of it. So, and then others, just like Alberta, you retain some of the money. So if you don't have enough to pay for it, you will get your full OS, CPP, GIS will be submitted to pay for your room less the retained amount. That's just some spending money. So you can see every province and every territory is different, but I sorted it by the most expensive to the least there. So you can know where you want to move 5 years before you feel you might need long-term care services. So, yeah.
And it's in looking at the number, it may not be that hard to stomach, but what you have to keep in mind is that this may be, as we mentioned earlier, in addition to the principal residence you currently live in.
Yeah,
if your spouse has to stay behind there.
This is also this is basic.
Very basic.
Government care. You'll end up at a facility of their choosing. You can say no, but you're back on the list then, waiting to get in. So you don't get a lot of say. You go to that facility and that's where you'll be. And I think what the biggest thing about long-term care and that we find with our clients is when it comes time for this situation is spouses want to be close to each other. Families want to be close to their parents. And if you end up so far away from where someone's lives, then you start looking at other options, either private care, which costs more money, or even maybe cohabitation where you and your spouse move into a facility together, but your spouse is receiving some kind of. So this is what your choices become because, like as we said, the most expensive option here is living at your own house and bringing care in. Second most expensive is living at your house, going into a long-term care facility. And so you start going down that list. Your third most expensive is using this option where you get placed wherever. So if you want the pick, it's costing more than this. So it's all about money and insurance, unfortunately, and preparing for this.
Having the money, I guess, gives you options.
Yeah,
as usual. So we go to our next slide. And we've touched on this, but I'm going to reiterate it here. So often a couple's health does not move hand in hand. When the household must maintain both the original home and these expenses, in addition to the long-term care needs of the unhealthy spouse, budgets can be strained. But keep in mind, both spouses may not need care at the same time.
Yeah.
If we go to our next slide, what we want to do is build a care plan that works. So there's some options when you're building these insurance plans. They can be quite flexible in terms of how we design them. So a couple of the things here that we want to point out is that there can be shared coverage for couples, which allows either you and your spouse or common law partner to share coverage. So you guys are both covered. If one spouse goes into care or needs in-home care, well, they're considered to be on claim or the couple's considered to be on claim. There are two optional riders that can be placed on these. One is an inflation protection rider. So you might buy this thing, 10 years before you need to go into a facility or require home care. The benefit amount that you purchase today is obviously not going to be worth the same 10 years from now.
$150 a day is not going to be $150 a day 10 years from now.
Inflation is going to erode that, right? So there is inflation protection riders that you can put on here, which helps you maintain your purchasing power of the benefit. And there's a return to premium on death rider, which can refund a portion of your eligible premiums if you happen to pass away and never claim on the policy. Care where you choose is another point here. If you're able, you can stay in your own home, or if you're in a facility, the care benefit will double to help cover the generally higher cost of this more formal type of care. And then there's care support services. So this is an extra benefit to help you and your loved ones navigate the long-term care delivery system in your local area. Even just trying to put these slides together, we recognize that it's very difficult doing Google searches and trying to figure out what costs are, what's available to you, what you need, what you can claim, what's subsidized by the government. There's a lot of hoops to jump through here. So something with care support services would be useful. So we go to our next slide. The monthly care benefit is yours to use however you want, whether you're being cared for at home or in a long-term care facility. So it's not something that's receipt-based. You can use these benefits for the actual costs of care. You don't have to report how you're spending the money. You just receive your benefit and choose how you want to spend it. You can even use it to pay a family member or a friend who's helping care for you. And so I did just a really quick example in terms of what premiums look like on these types of products. And we have an example here of a male who's 50 and a female who's 55. They've applied for a $3,000 a month benefit for non-facility care, which doubles, as I mentioned earlier, to a $6,000 a monthly benefit if they go into a facility. The cost for that is $4,500 per year. So that's what they would pay until they were on claim. So
and there's obviously a cap on the amount of benefit they get for the duration and things like that. But that's
right. Yeah, this is a good point, Dave. This is actually based on a $300,000 draw. So they have $300,000 of a piggy bank of long-term care spending, if you want to call it
100,
that. So
100 months in at home care, 50 months in a facility.
There you go. Just did that math all in his head.
But could be wrong too. So someone can send us a note after.
All right. So if we go to our next slide, I think that's our wrap up there. So thank you very much for watching this episode of the Tower Wealth Advisory podcast series. If you want to learn more about us, go to towerwealth.com or follow us on social media.